A year ago, I put $1,000 into each of 5 Dividend stocks: a bank, an oil company, a soda bottler, another bank, and a company that sells wrenches out of the back of a van. Not exactly a thrilling lineup, I know, but it beat the market by more than 2 to 1, and it paid me the whole way through. In this video, I'll show you exactly what those 5 stocks did over 12 months, what each one returned, what the whole thing is worth now, and every dollar of dividends it paid. And by the end, I'll show you how this portfolio is still sitting 44% below what it's estimated to be worth, even after already returning 42%. Quick heads up before we start. This video is sponsored by Simply Wall Street, and it's where this whole portfolio actually lives. It's a great tool for dividend investors who want to track and grow their portfolios, so I'll show you how it works as we go through. Let's start with the one that made me the least money, because it actually turned out to be the most interesting one in here, and it is Snap-on. Nobody clicks a dividend video to hear about a tool company. I get that. Snap-on makes wrenches, screwdrivers, sockets, diagnostic gear, and they sell it out of vans that drive around to auto shops, which is about as unglamorous as a business gets. $1,000 in Snap-on bought me 3.15 shares at $317.79 back in August of last year. Today, that's worth $1,285, up 28.5%, the smallest gain of the 5. And I'm telling you about it first on purpose. Because here's the thing about Snap-on. It scored a perfect 6 out of 6 on financial health, and it was the only one of my 5 stocks to pass every single risk check Simply Wall Street runs, apart from insider trading. So the most boring company in the portfolio is also the one with nothing wrong with it, which is sort of the whole argument for dividend investing in one stock. Snap-on's a company most people have never heard of. The next one has a name everybody knows, and it's not the company they think it is. The ticker is KOF. And when it showed up on my screen, I thought the same thing you're probably thinking. Well, it's not Coca-Cola. Coca-Cola is KO. KOF is Coca-Cola Femsa, the bottler. They're the ones who actually make the stuff, put it in bottles, and drive it to every corner store across Mexico, Brazil, Colombia, and a handful of other countries. Coca-Cola sells them the syrup. These guys do everything after that. $1,000 bought me just under 12 shares at $83.43. Today, it's sitting at $1,317, up 31.7%. But that's not why it's in here. Out of all 5 stocks, this is the only one with a perfect dividend score, 6 out of 6. 10 straight years of payments that stayed stable and kept growing every year without a cut. One honest note. It earns in pesos and reais, so what lands in your account moves with the currency. Some years that helps, some years it doesn't. So that's the trade with Coca-Cola Femsa, a perfect dividend record wrapped in a currency you don't control. The next stock has none of that going on, and it's the biggest company in the whole portfolio by a mile. $1,419. That's what $1,000 in Bank of America turned into. 21.9 shares at $45.66, and today they're $64.80 each, up 41.9%, which makes it the first stock in this portfolio to clear 40. Now the part I didn't expect. Bank of America is growing its dividend at 12.9% a year, the second fastest riser in the whole portfolio. Banks are supposed to be the slow, steady end of the dividend world, and this one's raising its payment faster than almost everything else I own. So Bank of America had a great year in this portfolio, but it got beaten by another bank. The best performing stock in this portfolio is the one nobody talks about, U.S. Bancorp. 5th biggest bank in America, headquartered in Minneapolis, and if you don't live near one, you've probably never heard the name. $1,000 bought me 22.76 shares at $43.94. Today, it's worth $1,480, up 48%, best of the 5. And it's not just the price. This is another 6 out of 6 on financial health, and it's raised its dividend twice in the 12 months I've held it, up to $2.08 a share. Now, while we're on U.S. Bancorp, let me show you something, because this is exactly the kind of thing I use Simply Wall Street for. When you pull it up, right under that perfect financial health score, there's a flag. It says there's been significant insider selling over the past 3 months. And your first instinct is to panic a little. Executives selling their own stock? That sounds bad. But a flag isn't a verdict. It's a prompt to go look. So you look, and right next to it is a bank with perfect financial health, a dividend that's gone up by 7% on average, and a stock that just did 48%. Insiders sell for all kinds of reasons. Tax bills, a house, diversifying after a run like that one. That's the whole skill, honestly. Not finding a tool that tells you yes or no, but finding one that shows you what's worth a second look, then reading both sides before you decide. So that's 4 stocks, all of them up. We've still got the total to get to and the cash these 5 paid out along the way. And remember, in the end, I'll show you how, even after such a solid run, this portfolio is still sitting 44% undervalued. But first, there's one stock left, and it's the one where the numbers stopped making sense to me. What happens when a stock goes up 45% while the business underneath it gets smaller? Because that's Exxon Mobil. $1,000 bought me 9.12 shares at $109.64 in August. Today, they're $159.75 each, so that position is worth $1,457, up 45.7%, second best in the portfolio. Now, pull up the earnings chart, and something odd shows up. Back in early 2023, Exxon was earning about $62 billion a year, but by this March, that was down to $25 billion. 3 years of that number going the wrong way. And yet the share price climbed the whole time. Some of that's just oil. 2022 and 2023 were a boom, and nothing was ever holding at that level. The most recent quarter was strong too. Revenue of $114.5 billion, up 44%, and net income more than doubled to $14.5 billion. But it's worth sitting with. What a company earns and what people are willing to pay for it are 2 different numbers. They don't always move together, especially in oil, where the whole industry rises and falls on a price nobody inside the company controls. Okay, so that's all 5. Now let's put them back together because the individual numbers don't tell you what actually happened here. $6,958. That's what $5,000 turned into, a gain of $1,958 in 12 months. Over that same stretch, this portfolio did 35.1%. Meanwhile, the U.S. market did 16%. So a portfolio of a wrench company, a soda bottler, an oil major, and 2 banks beat the market by more than 2-1, which is not how any of this is supposed to work. But that number is only the share prices. It leaves out the part that made me buy these in the first place. Here's every dollar these 5 stocks paid me over 12 months. U.S. Bancorp paid $47.34. Coca-Cola Femsa, $45.51. Exxon Mobil, $37.21. Snap-on, $29.77. And Bank of America, $24.53. Add it all up, and you get $184.36. Now, that works out to about $15 a month. And I know how that sounds next to a portfolio that just did 35%, but look at it as a rate instead of a number. $184 on $5,000 is 3.7% paid in cash on top of everything the share price did. Rates don't care how much you started with. The same 5 stocks on $50,000 will pay you $1,844 a year. On $100,000, it's $3,687. The percentage is the thing that you're actually buying. And there are 3 things buried in that $184 that I didn't expect. First one, dividend income doesn't show up evenly. August paid nothing. November paid nothing. February paid nothing. Then December landed $34.27 in a single month. So if you're picturing a steady paycheck, that's not what this looks like. It's lumpy. Second one, and this is my favorite number in the entire video. U.S. Bancorp pays 3.2% to anyone buying it today. I am getting 4.7% because I bought it a year lower and the dividend went up twice since then. That's called yield on cost, and it's the number that tells you how your income is doing rather than how the stock is doing. Across the whole portfolio, it's 4% on cost against 2.8% for anyone buying in now. Third one, Snap-on made me the least money of any stock in here, 28.5%, and it's raising its dividend at 13.3% a year, the fastest of the 5. Exxon Mobil nearly won on price, and it's raising its dividend at 3.1%, the slowest. So the stock that made me the most is actually growing my income the least, and the one I nearly skipped is the one doing the work. Okay, so let's add it all up properly. $5,000 went in. 12 months later, the shares alone are worth $6,958. So the market put $1,958 on top of what I paid. Then there's the cash, $184.36 in dividends that landed over the year and never showed up in that share price at all. Add it to the $6,958 and you get $7,142. $2,142 on $5,000, 42.8% in 1 year. So that's what this portfolio made me. Now, here's what it's supposedly worth, which turns out to be a completely different number. $10,010. That is simply Wall Street's estimate of what these 5 companies are actually worth based on the cash they're projected to generate. The portfolio is trading at $6,958 today, so there's a gap of $3,052 between the two. Now, you'll see that same gap written 2 different ways, and both of them are right. Say there's a jacket that normally goes for $100, sitting on the rack at $70. The tag says it's 30% off. But if you bought it and resold it at full price, you would have made 40% on your money. It's the same $30 either way. One number is measured against the full price, the other against what you actually paid. Same thing here. This portfolio is 30% below what it's estimated to be worth, which is the same as saying there's 44% upside from here. And I want to be careful with that because it's a projection, a model built on forecast cash flows. It's not money in my account, and the market has no obligation to ever agree with it. And by the way, everything I just pulled up there, the income breakdown, the quality scores, the fair value on the whole portfolio, you can run all of that on whatever you already own. And honestly, that's just a small corner of what Simply Wall Street actually does. So here's what I'll do. I'm dropping the link to this exact portfolio down in the description. You can open it up and go through everything we just covered, live, moving in real time. And if you sign up using that same link, you'll get 30% off and an extended 14-day trial, no credit card required. So go ahead, pull it up, poke around, and see what your own portfolio looks like in there. Now I owe you the other side of that number because a portfolio that beat the market 2-1 deserves an honest answer to one question. Why did this actually work? 2 of my 5 stocks are banks. Add them up and financials come to 41.7% of the portfolio. And banks, they had a year. That's a big part of the answer right there. Strip out Bank of America and U.S. Bancorp, and this portfolio still beat the market, but not by 2-1. There's a second thing in here worth knowing. On earnings, these 5 are cheaper than the market. 16.1 times against 19.2 for the U.S. market as a whole. But measure them on growth instead, and it flips. The portfolio sits at a PEG ratio of 2.6, where the market is at 1.5. In plain terms, I'm paying nearly double per unit of growth, which is what dividend stocks are. These companies hand you cash every quarter because they've run out of better places to put it. That's the deal you signed up for. A 40% year isn't the normal outcome for a portfolio like this. It's what happens when the sectors you happen to own have a very good 12 months. Now, this was last year's portfolio. If you want to see what I'm holding this year, that video is on screen right now.